as we continue with Chapter 5, we're going to add some more terms, some more formulas to what we've learned before. So hopefully you've got your notes printed and you've got your formula sheet handy and ready to go. So we're going to start talking about a concept called contribution margin. Contribution margin is the difference between sales revenue and variable cost. So revenue minus cost, your selling price minus your variable cost, gives you this contribution margin. It's similar in concept to gross profit, but not exactly, because gross profit, as we'll see in a minute, includes all of the product costs, both fixed and variable. But contribution margin is just looking at variable cost, regardless of whether those variable costs are fixed variable cost, or are obviously they're not fixed variable cost, that doesn't make sense, whether they are variable product cost or variable period cost, okay? So contribution margin is called that because it's the amount that's left over to contribute to fixed cost and profit. Now we're going to talk about contribution margin both on a total level and on a per unit level. So at its most basic, contribution margin is just sales revenue minus variable cost. I called this one CMT in my notes because that's the contribution margin in total. So it's my total revenue minus, let me erase, I didn't mean to change color. It's my total revenue, or what I just call revenue, that's the total, minus the variable cost in total. So in our example, if we are selling 200 tablets at $500 a piece, then our total revenue is $100,000. If our variable costs are $275 a tablet and we're selling 200 tablets, then our total variable costs are $55. Therefore, the total contribution margin is $45,000. Now, that's again the CMT, the in total. We could also do it on a per unit basis by just saying, I call this CMU is equal to the selling price per unit, which is what I call SPU, minus the variable cost per unit. So in this case, my selling price per unit is $500, my variable cost per unit is $275. So that tells me that my CMU is $225. So that's here on this next slide. I jumped ahead, I got excited. So when we look at it on a per unit basis, the sales revenue per unit, which again I call SPU, that's just my own personal designation, minus the variable cost per unit, is equal to the CMU, your contribution margin per unit. So that's $225. Now there's one more that we need to look at, which is called the contribution margin ratio. Now a ratio, because it's just a relationship between two numbers, it can be in total or it can be per unit. So the formula that we see here is contribution margin in total. Okay, so what I call this one CMR, it can be your contribution margin in total divided by revenue, or you could use the contribution margin per unit divided by the sales price per unit. Either way, you're going to get the exact same answer. It just depends on which data is more handy or more readily available for you. So in this case, remember our contribution margin in total was $45,000 divided by the total revenue of $100,000, which gives us 45%. Or we could look at it on that per unit basis. So remember our contribution margin per unit was $225 and our selling price per unit was $500. So that gives us again 0.45 or 45%. Now, We need to look at what's called a contribution margin income statement. So a contribution margin income statement is not a GAAP income statement. So this is never something that you will see in an annual report. You'll never see it published. It's one of these internal only things. Now, a regular income statement, the multi-step income statement that we learned back in Chapter 5 of Financial Accounting, classifies or separates cost by product cost and period cost. And we talked about this a little bit back in Chapters 2 and 3. So the product costs, those direct materials, direct labor, overhead, they all ultimately wind up on our income statement under cost of goods sold. So when we look at that income statement, revenue minus cost of goods sold gives us gross profit. Cost of goods sold is all of our product cost. It's the direct materials, the direct labor, and the overhead. Some of those product costs are fixed. Some of those product costs are variable. Then the operating expenses, so again, if you're thinking of our traditional income statement, revenue minus cost of goods sold gives us gross profit, minus operating expenses gives us income from operation. Those operating expenses, we also call them general selling and administrative expenses, are all period cost. So these are all of our operating expenses or general selling and administrative. So a contribution margin income statement is just going to take those costs, product and period, and reshuffle them based on whether they are fixed or variable. So instead of breaking it by product and period, we're going to break it by fixed and variable. Let's take a look here. So under our traditional income statement, this is what we were just talking about. Cost of goods sold is all of our product costs. Some are variable, some are fixed. Our selling and administrative expenses are all of our period costs. Some are variable, some are fixed. So the contribution margin income statement is just going to shuffle those costs, just reorganize them, where we're going to say revenue minus all variable costs, regardless of whether they are product or period. That gives us contribution margin, that contribution margin in total. And then we're going to subtract out all of the fixed costs, some of which are product, some of which are period. Now, operating income is going to be the same under both methods. We didn't change total cost, we just reshuffled them. The reason that we want to reshuffle them is because we want to know how the costs are going to react. Okay, so for example, if sales are declining or we are anticipating sales may be declining, I'm recording this in July of 2020. We are in the middle of a COVID-19 pandemic. Sales in pretty much almost all industries have taken a huge hit. Okay, when sales decline, variable costs also decline. However, your fixed costs do not. So we need to know, and we'll talk about this a little bit more as we go through the chapter, how our total profit's going to react, okay, based on whether the cost is fixed or variable. If sales are going down, we're selling fewer units, we're producing fewer units, we can expect sales to go down. We can also expect total variable costs to decline. However, those fixed costs are not going to change, just by nature of them being fixed cost unless we do something. So we need to know, this is called operating leverage, and we'll talk about that more a little bit later. We need to know how our overall profit's going to react. How much money are we going to lose? Okay, because it's not a one-for-one. So this is why it's so important that we look at these not just from a overall profit perspective, but that we look at them from the perspective of their cost behavior, so that we can analyze how they're going to go down. Because we can't say that because we're selling fewer products, all of our cost of goods sold is going to decline by the same amount, because it won't. Some of those cost of goods sold are fixed and they're not going to decline. So this is really important. We'll come back and talk about this more. We'll talk about some more in a later chapter also. I just want you really to kind of be thinking about that concept about how the cost of behavior affects overall profit, especially in periods where we're seeing rapid decline in sales or even rapid increase in sales. They both play a part in this.